Hey guys, I think this is our third get together with our options trading group, and I'm excited to share some new things with you guys. So, like I always like to start off this is the final exam question based upon last week. What have you learned since we last met, and what have you tried and practiced? So, who would like to go first? One at a time, please. All right.
I can go.
Okay,
Okay.
Nancy, the faceless person.
So I tried the poor man's covered calls. I mean, I placed all the trades for that and the poor man's covered puts. I think is that what it's called.
Okay, yep.
And seems pretty interesting. So I want to try it on my real account. So I just want
Okay.
to practice it here
Yeah, well,
on a weekly one because the one I did was I think a longer expiration. So I'm going to
okay.
try it on a weekly one and see how it goes.
Now,
So that's
what would you say is the advantages and disadvantages going weekly versus monthly?
it's a weekly income.
It's a what?
It's a weekly income coming in,
Okay, it's
right?
a weekly income. All right, that would be an advantage. Anybody
And
have a potential disadvantage?
Volatility.
Volatility? I would say liquidity. Sometimes the weekly options, depending upon the underlying, don't have as good of a liquidity. And if the liquidity is bad, how does that impact you?
Wider spread, and you get
The
paid.
wider bid-ask spread. So if you're getting in and out, remember the analogy of the bad money changer at the airport that sees you coming. So you leave some money on the table. It's the hidden cost of trading is that spread between the bid and the ask. That's why I prefer to kind of trade the most liquid underlyings.
Can you comment, Dale, at all on spread for SPY or SPX versus Tesla versus like the little one I did today, PCOM, or that kind of thing?
Yeah. I mean, you can get on the heavily traded, a 5 cent or less spread between the bid and the ask. On the other hand, you start getting into illiquid, less liquid, you might be talking 10 cents or more, 14 cents. So, let's say you're trading 10 contracts, and that spread is 10 cents. Take 1,000 and multiply it by 10 cents. And if you're getting in and out of it, you may be leaving $100 on the table. A C note.
Yeah.
And that can add up. You may not be trading it, but even if you're trading one contract, it's still leaving an extra 10 bucks or more. And that's that hidden cost. So many people focus on their commissions, but the hidden cost of trading is that bid-ask spread. So just look at it as you trade things and just be aware of it as you go. Anything else, Nancy?
also, can you roll it? I guess it'll be a disadvantage if I roll it, right?
If you roll your short leg,
Yes.
yeah, you will roll your short leg from 1 month into the next
one
month.
month.
So let's say you're buying the January and you're selling the November. Well, the day before expiration or a few days before expiration, you'll roll the November to December. And then as long as you have a bullish premise, then when December is almost expiring, you roll December into January.
What if it goes against your strike? Like
What if
past
it
your strike?
goes? What if it goes in the money?
Past, yes.
Well, you can still roll it for ideally for another credit.
Oh, okay.
Even though it's in the money, you can roll it for a credit and just kind of milk that for all the premium you can get.
And that's our objective here on these poor man's covered call, covered put.
Rolling for a credit. I always like to roll for a credit. The only reason I would roll for a debit, gosh, I believe nobody knows anything, but let's say you knew something and the underlying, you want to give the underlying a little more room to run for some reason or another. But I have so many more opportunities than I can take advantage of. So I'm just like, well, I'll just milk this one. And then when this one runs out, I'll find another one or put another trade on. So I think I can't really think of a reason why you wouldn't want to roll for a credit. Once things get deep in the money and I've got some buying power, if I'm still bullish on the underlying, there have been times where I rolled for a debit, but I prefer to roll for a credit. It's a good habit to have. Anything else, Nancy?
No, that's it. But
Okay,
it's two things I learned, which was helpful.
great. All right. What about the rest of you
So
star performers?
So I kind of learned pretty detail about how all the spreads work in the diagonal spreads and how the naked puts and the naked calls work. I also took some trades on the poor man's cover calls, and then during the week I had spoken to about the SPXS trade that I took, and it was just an experiment. I used to trade SPXS like as a daily day trade. It's 3x leverage ETF that goes against the SPY. Works if the SPY is going up, it'll go down, and when the SPY goes down, it goes up. And I've been kind of in the mindset that the SPY is overbought and it's making new highs. So I decided to take this trade, which has not been working in my favor so far. But I'm still trying to ride it till past the elections, and then I'll see.
Well, the market's been moving up, so that's kind of yeah. Which when Jamal first talked to me about this trade, it kind of made me do a little mental dyslexia because I was thinking, wait, you're putting on a bullish trade on a bearish 3 times underlying. You know, kind of my head exploded. You know, just trying to kind of. So if it goes up, you want the market to go down. In this case, it goes up. You know, and so it's just yeah. I said, well, what better time to try something new than just in this contest while you're learning? So yeah, go ahead and try it and see how it works.
Yeah, so I took a Forsman covered call on that, and also there was a few others that I wanted to take, but I noticed that because of the 5% cap, it kind of limits on what stocks we could trade. Like it doesn't let you trade like Tesla, Amazon, or any of like the big cap stocks.
Sure. Yeah, and some of them, if it's close, you kind of look at the buying power, and if it's close, Nancy had one of them that was close. What was it you were trading, Nancy? It was Alibaba. Yeah, BABA. And I figured out if you bought the December and sold the November and bought the 60 delta and maybe sold the 30 delta. So there's kind of times where you can massage your strikes a little bit and get it to fit.
Okay. Yeah, so there was, I really wanted to take the Zoom trade, so I bought a little bit closer in time, which I usually don't like to. But I ended up doing it just because I had a feeling that Zoom was kind of oversold and it was going to go up.
Okay. Greg, are you still with us, or did you just lose your video?
No, I just dropped off on the video because I was looking up something.
All right.
Let me pull it back up.
Well, at least we've got progress, and you're not showing up as Allison this week.
You're gonna get it.
Yeah. All right. All right.
Yeah, I also bumped into the same corners they were talking about, the max limit and all that. I figured I got to get up higher, so I'm getting as close as I could and playing with that. Yeah. I learned how easy it was to pull up the wrong option chain, and then had to question you on it. But I got it straight. I only got one trade on today. I want to get about 3 more tomorrow to fill the gap that I should have had done by today, but just had some issues. So
gotcha.
I'll get those off tomorrow, and I'm finding it valuable to push through and force yourself to get it, to get it on, to make it happen.
Right.
And that's been valuable to me. So.
Good. All right, OJ, Johnny Juice Ball.
I kind of learned a lot. I learned, the capital requirements for each trade, more about efficiency, depending on the size of your portfolio, putting how much of it to work, like what it would cost for each trade and the benefits, with regards to volatility for each one. Like the poor man's covered call or puts, there's not as much volatility as selling options with like this week's expiration, and stuff like that. So just managing, different allocations of capital and the risk with it.
Yeah.
Yeah, setting some for long term, setting some for like what Nancy was doing, a weekly income or something.
Sure. Well, one of the things I wanted to ask each of you to do, if you would go ahead and put each trade into the categories that we're teaching. And the reason I want you to do that is so you get an idea of how each one of them is performing. So if you're just putting them into bullish and bearish, I'd like for you to put them into the trades we've learned so far is selling naked calls, which is bearish, selling naked puts, which is bullish, poor man's covered calls, which is bullish, poor man's covered puts, which is bearish. So every week we've learned one bullish trade and one bearish trade. And I'm excited about this week because we haven't broached the topic of neutral trades. So today we're going to trade two or three different types of neutral trades. And one of the things I'm going to teach is does anybody know what a strangle is? One at a time. Once again, one at a time, please. Does anybody know what a strangle is?
You did tell me, but I forget.
It's the old forget trick. All right. Well, I'm going to share my screen here and describe kind of what a strangle is. And let me, a strangle is a neutral strategy. I'm going to share this screen. Tell me when you can see my screen.
Yes, sir. We got it.
Okay, you got it. It's a neutral strategy. And you're selling both the put and the calls out of the money. 20 to 40 delta. Now, it's an undefined risk trade, which means theoretically your risk is unlimited. The higher the delta, the lower your probability of profit. So roughly, if I'm selling the 20 delta, you might expect a 60% probability of profit. If I'm selling the 40 delta, your probability of profit is lower. The higher your delta, the lower your probability of profit. The lower your delta, the higher your probability of profit. So it's kind of a balance between theta, which you can think of as income, and probability. And my preference is to always, because I like to kind of run it like I'm running a casino or like I'm playing Pot Limit Omaha, is I always like to get my chips in the middle when I have a 55% probability of profit or more. And especially if, you guys that play poker know if it's a multi-way pot, and you're kind of at 55%, what would you do in Pot Limit Omaha, Johnny Juice Ball?
Have it. I mean, yeah.
Bet the pot.
Yeah, get max value.
Right. So it's this balance. So my favorite delta is about 30 delta. So now the big question is, if you got a strangle and it goes against you, what are the two ways it could go against you if you're selling a put and a call? What are the two ways that trade could go against you?
If it goes up or down in value?
Okay, if it goes past either one of those strike prices. So you're selling a put and you're selling a call. So the two bad things that could happen to you is if it crashes past that put or if it crashes to the upside past that call, right? So now the question is, how do you manage that trade if it goes against you? So you could assume that when you set this trade up, maybe you had a 60% probability of profit. And now something even, you played this hand of poker and they got lucky and they drew out on you. So you're forcing the market to beat you. So if it goes against you, any ideas what you would do?
Roll.
Roll. Which side would you roll? So let's say it goes against you to the downside, crashes to the downside, it goes past your put. What do?
I was thinking of rolling before it got to me, but
Oh, roll it before it gets to you. That's an option. Let's say you still got some time left in it. Let's say it's way out into November. It's 30 days from now. You had your put side get tested.
Sell a call against it?
Sell a call against it. Here's what I would do. Here's my favorite thing is to roll the untested side. So anybody know what a straddle is?
Yeah.
What's a straddle?
I know straddle like in poker term.
Okay, in poker terms. Straddle in options is where you're selling a put and call, both of them at the money.
Okay.
So let's say, what's Apple trading at currently? Anybody?
114, I think.
114. Let me pull up the trade. Is it 114?
115.92 right now.
115.92.
Yeah.
Okay, so a straddle would be if I'm selling both a put and a call at say 116. So Apple's trading at 115.75. So let me see if I can give you a real example here. I'm going to stop in, and Johnny Juiceball is yawning. He must have had a hard day selling mortgages or something. Did you? All right, I'm going to share my white screen here, and I'm going to give you some real kind of numbers here. So let's say we're selling. Any of you guys have access to a trade here? I'm going to put on Apple. We'll look at Apple. And if we're creating a strangle in Apple and we're selling a 30 delta, let me look here. The put, a 30 delta put, or let's say a 24 delta put is 106.25. 106.25 is the put price. And that's at a 24 delta. Got these screens and I need to move one out of the way. 106.25 is a 24 delta. So let me find a 24 delta call, and that's trading at 127.50. Okay, so Apple is currently trading right close to 116. So as long as it stays between these two strikes by expiration, in this case, expiration is November 20th. So let's say tomorrow we've got this strangle on and it goes down to 106. So what I can do is the untested side is this side, the call. It's tested, the put side. So what I'm going to do is I'm going to roll this 127.50 down to 106. And what that does is it creates a straddle. So what I do is I'm collecting additional premium when I roll that down. So every time I collect premium, it lowers my cost basis.
You're rolling down to the at the money, you're saying?
I'm rolling down to at the money. So my favorite adjustment is whenever it blows past one of those strikes, you turn a strangle into a straddle, And what you're hoping to do is to turn a loser into a scratch or a small winner.
Yeah.
And so when you do that, you can maybe take your win rate from 70 to say 75%.
And you're still in November.
You're still in November.
Okay.
All right.
So how is both of them at the money? What you're doing Apple, right? Or Facebook?
Well, I'm hypothetically saying that if it went down to 106 and your put was at 106.25, it's blown past your put. So when you roll your call down to 106, now you've got a straddle and you've collected extra premium.
Okay.
What if it goes a long ways below it?
You could still, your first goal is to strangle into a straddle. So here's the different types of adjustments. So first, your first adjustment is to turn your strangle into a straddle. Your second adjustment is to go inverted, which means actually your call could be below your put. That's called going inverted. Your other option is you could take the long or the short and sell premium against it. So Greg, if you're familiar with the what we call the wheel strategy,
Yeah.
wheel strategy can work not only for long stock, but it can work for short stock. So you could try to shift gears and say, you know, I didn't intend this. It started out as a strangle, but you know, it's blown so far down, I wouldn't mind owning this stock and selling calls against it. And if you've got enough money in your account, you're like, okay, I'm just going to take this stock and then I'm going to start selling calls against it. So what started off as a strangle could turn into a covered call.
How do you go about grabbing it, the assignment process? What do you do?
You don't have to do anything. All it has to do is go into expiration, and if that put is in the money, boom. Next trading day, you're long stock.
Got it. Okay.
If it goes past the call in the money, now you need to make sure you've got the money to handle it, a long or a short, to take assignment, and that's all just has to do with the size of your account. If you don't have a size of account to take the long or the short, then you'll have to say, well, just close it and take the loss. On to the next trade, right? So those are at least three options of managing strangles. And just in a second, I'll put on a real strangle, and then I'll show you. I've got one that I believe it was, I think I've got one that went against me in my $1 million trading account that I'll demonstrate an adjustment that I need to make. So that's a little bit about managing strangles. And then straddles is where you're selling both a put and a call at the money. It works well in extremely high volatile environment. I will say it's not my favorite trade. The reason being is I like to start off with a strangle because it gives me some room to make an adjustment. Now, there's one other, so rolling up the untested side to turn a strangle into a straddle. And then the last thing I wanted to teach is an iron condor. And anybody know what an iron condor is?
Yes.
How would you describe an iron condor?
It's a string that stops.
It's a strangle with
Stops.
or legs. And the legs could be thought of as insurance, and it turns an undefined risk trade into a defined risk trade. And it's also probably better for smaller accounts because it can take less buying power. Strangles may take more buying power. Adding some wings or legs as insurance can help lower the buying power for a smaller account. So in essence, it's a defined risk trade. where you sell a strangle and buy wings. The wider the wings, the more it's going to behave like a strangle. Wings serve as insurance. Insurance may negatively affect your profitability, just like buying insurance, Greg, on your restaurant. You know, it slows down, lowers your profitability, but you do what you have to do to protect yourself from getting blown out of the game, right?
Yep.
OJ, did you know that Lower Greenville restaurant at Greg Mirko, this restaurant, it burned down? Did you know, Greg?
I know I did not.
Okay, yeah, he learned that the hard way when his restaurant burned down. Insurance may negatively affect your profitability, but it serves as a drag, but it keeps you in the game, and it lowers the buying power for some of your smaller accounts. So that's, in essence, the definition of an iron condor. So those are the trades that I wanted to teach today. And what I'd like to do is do a couple things. It's now halfway through. I want to stay to an hour, kind of an hour once a week. But I thought I would put on some a strangle as an example, and I'll put on an iron condor. I'll show you the risk graph in Thinkorswim, and then we'll go on trade diff and we'll put some on based upon maybe some of your suggestions. So cool. Let's go into toss now. And one of the things that I have done, and I've put this in some of your information, is creating a scan for volatility. And kind of this is something that I'm doing right here. I think this is not, let's see if I can lower this to be able to kind of see it a little bit better. Here we go. At least I thought so.
Usually like a scroll bar. That's...
Or hit that up button on the left, bottom left, or
this one.
Yeah, that one, I think.
Okay, here we go. All right, so this is kind of a scan for volatility that I kind of wanted it to be a little bit larger, but this is kind of a watch list for liquid ETFs. And I guess I sent you guys the Excel where you could actually do this in toss. So it's kind of liquid ETFs. And there's also another one that I like, which is called Sosnoff Setup, which is kind of the most liquid underlying. So I put all this in the shared file folder for you guys. So let's do, anybody have an example of a trade? Let's look here at kind of a rank, some of the high volatility, and see kind of what some of these underlyings might look like. Alibaba might be a fairly good one. I'm not sure if it will fit into our requirements in terms of buying power, but let's just see. So if I click on trade here and I go into Alibaba and I look at November, and first we'll put on a strangle and then I'll turn it into a straddle. So what I'm going to do here is I'm going to look for, say, here's a 26 delta here at 285. So I'm going to hold down the control button. I'm going to sell this guy 26, and I'm going to try and find a 26 delta on the other side. Here's a 28. So let's do one contract here, see what kind of real buying power it would take. Right click, confirm and send. It takes about $4,000 in buying power in toss to put this trade on, but I would collect $1,229, which would immediately drop into my account. So I'm going to click on right click and I'm going to click analyze this trade. And I'm just going to show you guys, I'm looking for that. If you don't ever see the dotted line, you can click up here and click on reset and reset it. And you should see there's two. So I'm going to click this hashtag is the break even at expiration. And then I'm going to put this one on the break even over here on the right hashtag. Now this number here has to be today's date. So in this case it is. And then the top number has to be the expiration date. So in this case, it's November 20th. So I'm going to change that to November 20th. And then I'll see it has a 63% probability of profit. So I like that.
Hey Dale,
Yep.
quick weird question for you. What do you do on a calendar situation on the top right date when you have two different wings and they're different?
I put that on the expiration date of the short leg.
Thank you.
But realize that you may have more than one time that you're going to sell that bad boy. But that just gives you your probability of profit for that one short leg.
Yes.
So there's that probability of profit for that guy. Now let me go in and turn this strangle into a straddle. Okay, so I'm going to go in here. I'm going to look at my legs were 285. And let's say you got buying power, and I'm going to do a 30-point wide wing. I'm going to buy the 255, $1.86, and then I'll go down here and pick a comparable one. Here's a $1.74. I'm going to pick that guy. I'll change it to one contract, and then I'll do the analyze tab. And now this has become an iron condor. So now I'm collecting, rather than collecting $1,000, I'm collecting $881. I'll click on this and click analyze. And now you want to make sure that only the one is checked that you want to analyze. So I'm going to check on the iron condor. And so I'll change this a little bit so you can see it. So now my probability of profit is 59%, 57%. Still better than a coin flip. So for me, that's always being like the casino. If it's greater than a coin flip, my max loss now becomes $2,100 on the downside, and it's my max loss on the upside is only $368.
Hey Dale.
Yeah, but my max win's 881.
Why is the date on the lower left 11/21 in blue, and then top right is 11/20? What's that mean?
That just means it has to kind of go to the next day before it's really milked all your profit.
Okay.
So, if it's November 20th, it hasn't expired yet, right? So now November 21st, all that juice is out of that lemon.
Right. Okay.
So it just shows you kind of how to use TOS to analyze a trade, to how to show probability of profit. And I would encourage all you guys, just wear this out. I mean, wear out your analyze tab, because see these numbers here? You can slide it around to kind of see what the current price is, and you can play kind of war games with what if scenarios to see, if it closed at 321 and I closed it today, I'd lose $93. But if I close it at expiration, it expires at 322, I make $881. Now, give me the proverbial head nod if you follow that.
Yeah.
Okay. All right. So that's a demonstration of a straddle and a strangle. So now all of a sudden, let's say the price goes down and it hits that put of 276. So then what I would do is, what would you do? You roll the call down to 276 and you collect that extra premium, and that strangle becomes a straddle. So let's just set up a straddle and see what the risk graph looks like on BABA. So BABA is currently trading at 306. So, if I change this short put and let's just take it off, delete it, and I'll go in here and set up a 305 as the closest price. So I'll sell this guy, turn it into one contract.
You held down your control key when you clicked on those?
I sure did.
Good.
And that's the way you can kind of, I'll just check that straddle, and it's a similar kind of risk graph, but if you can ever ping the, if we were psychic and we could ping that closing price, you know, it's like the trifecta, right? We'd win 28-48. So, you know, even the psychic hotline went out of business. Don't you think Dionne Warwick would have seen that coming? Yeah. Okay, hold your applause. You know, I'll be here all week. All right, so that's an example of a strangle and a straddle. So now let's kind of go in questions.
Yeah, when we do the straddle, is the maximum profit if it stays within the range like a neutral stock, whereas like you don't want the stock to move as much, right?
Right. You kind of want to pick something, and you make more money by selling premium when volatility is high. So when blood's running in the streets, when people are scared to death, you're selling premium on both sides, and you're trying to hold. And there's two ways you'll make money. One is when fear relaxes, you'll make some money. You also will make money if it stays within those two strikes. But you could also win even if it goes outside your strike, but it doesn't go far enough to wipe out your premium. So let's say you collect $5. You got $5 on either side of that that'll still make money. Right?
And do you only make money by the premium you collect, or does the price of the stock?
You only make money on the premium and collect unless you roll one side up or down,
Okay.
and now you've collected more premium.
Gotcha. So basically, you're only collecting premium, like that.
You're only collecting premium, but that's what your daily theta decay is, kind of your magic number. So just like owning a casino, you're, you know, start getting that daily premium and daily theta decay. So you're trading around a core of daily theta decay. So if you have a balanced portfolio, and kind of what I've taught you guys so far is at least you can set up a portfolio where you have some balance between longs and shorts, and you just kind of want that premium to come in. So,
Yeah.
So like a stock like AT&T that doesn't move a lot would be a good.
actually it wouldn't, because it doesn't pay much in terms of your option pricing.
Okay.
So the reason you pick things that are highly volatile is that you get paid. So selling premium on AT&T would kind of like be selling hurricane insurance in Oklahoma. Well, tornado insurance would be expensive,
Yeah.
but earthquake insurance, well, maybe not. Maybe that's not a good analogy. Earthquake insurance would be cheaper, unless you live in kind of on the middle of some fracking place, right?
Yeah.
So, do you guys want to put some examples on in? So here's my $1 million challenge, and Mike has enabled it for after hours just for demonstration purposes. You won't be able to put actual things on, but you guys want to put on some strangles?
Sure.
Okay, give me an idea for something that you might like to try to sell a strangle on.
Let me see. What am I doing?
And it could just be anything. Pick something that's fairly liquid. Something that maybe you don't currently have on. Just out of curiosity, you want to try AT&T? I mean, just to kind of, I just said it wouldn't be a great example. Let me show you why. AT&T is T, is that right?
Yes.
Okay, it's trading at 28.23. So if we go into kind of the monthly here, let's look at the 20 delta. You know, it's not horrible. It still is 27 cents here. So if the 24 delta put 27 cents, and then I go over here at 24 delta at 29.50, you know, I'm only getting 20 cents a day in theta decay. You know, I guess I could crank that guy up, you know, for $5,000, and I'm still only collecting $2 a day in theta decay. So you kind of see what I mean?
Yeah.
So this is, you know, AT&T is great for retirees because it pays a nice little dividend, but it's kind of like, people who trade utilities, right? I mean, it's people buy AT&T for the dividend, but it sure isn't something that you're going to make a lot of for theta decay. So that's kind of illustrates my point, Jamal. So it's kind of a two-edged sword. Even though it doesn't move a lot, your downside is it doesn't move a lot.
Let's try DraftKings because it's been moving.
All right.
So
What's the symbol?
DKNG.
DKNG. Okay. So we'll click on get the chain for that guy. And we'll look at November here. So if I'm looking at kind of the, we're showing kind of and it may be, I don't think the liquidity is not great. Here's kind of a 20-cent spread. But just for illustration purposes, I'll go ahead and still, instead of a 20 delta, I'll go with a 34 delta here, sell this guy, see if I can find a 34 delta over here. Here's a 34 delta, sell that guy. So it's a 40, 51, 50. And, I guess I could theoretically go as much as 6 contracts and still get below the 5,000 margin.
There you go. $100 a day.
Oh, it's $100 a day. So I'm going to go ahead and I'll click submit on that guy. And so then what I'm going to do is I'm going to take DraftKings and I'm going to put it into a category called Strangles. Now, Nancy had the question earlier today of, let's say it comes time, and I want to encourage all of you guys, if you've sold weeklies that expire tomorrow, to close them before expiration tomorrow, because on our site, we don't have the capability to go take you into short and take you into long stock. Plus, I think if that's the case, it's just good practice to close it, because if your account sizes are small, you don't want to wake up and be long stock or short stock unexpectedly. So if you've got expirations tomorrow, expiring tomorrow, some of you may go ahead and close that short leg. And if you still have the long leg, reestablish it either for the next week or further out.
We can still close it tomorrow, right?
You can close it tomorrow. Yeah, close it during market hours. It doesn't close. It doesn't expire till 3 o'clock tomorrow. So you've got till 3 o'clock tomorrow to close it.
Well, no, because I have a Tesla play expiring tomorrow. I'm like, I didn't want to misunderstand this whole concept and lose money.
Yeah. Well, you've got time. Hopefully I don't ever give you a suggestion for something after the fact. But yeah, you've got until 3 o'clock tomorrow to close it. So the way you close it, hopefully you guys know, is you click on these 3 dots and you just select close. Right? Now, if you want to just close one of the legs, but not both of the legs, let's say I just wanted to close one of them, you just open it up here, click on the leg you want to close, and then choose close. Make sense?
Yep.
All right. So now what we've done today is I've described Strangles, Straddles, and Iron Condors. I've also explained how to make adjustments for Strangles that go against you. We've talked about liquidity. We've talked about how volatility impacts kind of option prices, how to screen for candidates for Strangles. So, what questions do you have? So what I'd like everybody to do is your assignment between now and next Thursday is to put on a couple Strangles and a couple Iron Condors. If you want to experiment and also put on a Straddle, you can. It's not required, but at least a couple Strangles and a couple Iron Condors, and put them into categories. So Greg, you had a question?
I wrote the word neutral next to Strangle.
Yep.
And I'm trying to think on that. And what did that mean in terms of buying a? I was a little confused by the neutral.
Okay, a neutral means you really want it to stay within a range. So if I sell a put and I sell a call, ideally you're playing the range.
Yeah.
You make money as long as it stays between those two strikes.
Uh-huh. And we just picked a real volatile stock that we placed just the last one we did, right?
Right, but we still picked probabilities that we felt comfortable with. So the probabilities will play itself out. That's built into option pricing.
Okay.
Your delta
I get it. All right.
and your premium.
Do you still stick to around 30 delta, ideally?
Well, I tell you what, I have been hurt badly by Tesla because I've never seen something crash to the upside, like that stock. So if I sell something in Tesla, I'll go to 5 or 10 delta. I'm not usually a superstitious guy, but it left scar tissue on my rear end, so that I tend to want to only trade the highest probability of profit and not to take very much risk in that guy. I mean, you probably in the last year have seen some crazy things happen. One was in some of the weed stocks. You've also seen it happen in oil prices and options around futures where, it actually went below zero, your cost to carry, you never saw that before. And you've seen it kind of in Tesla just crash into the upside, go from 600 to, 12 or 1400 in a relatively short time period. So, I'm usually not, they say that not being superstitious is really unlucky. And, maybe that's me, but I tend to trade Tesla as a kind of a 5 or 10 delta. I traded a 10 delta iron Condor on Tesla and it worked out. I traded maybe a 20 delta on Netflix and I've kind of been hurt by trading some earnings trades. So whenever I'm trading earnings, I try to get further out. There's also something on TOS called an expected move. And let me show you kind of what that is. If you go into the trade here, and this, you guys might find this interesting, is anytime I go into Thinkorswim, in this upper right, I'm in an option trade for Alibaba in November. But if I look up here at the upper right here, it tells you what the expected move is in November in Alibaba. And the expected move is plus or minus 31 points. That's a high volatility underlying. Now let me show you AT&T. AT&T in November is plus or minus $1.50. So you're right, Jamal. Those are kind of safer, but you know what? When it's safe, you don't get paid. You get paid for taking risk.
That's not true. You can get paid.
Okay. Well, I mean, not in the options world.
But looking at those guys that take like those shots at, they'll buy 1,000 contracts. And, the Taco Bell theory where selling $1 tacos, I need to sell a lot, but still I'm going to make money.
I'll give you that. I'll say in the options world where things are very low volatility on a utility stock or something like that, it's hard to make much money in terms of selling premium.
Yeah.
There was a guy last Friday bought $4,000 of puts in FSLY, and overnight made like 480K.
Yeah, and it'll happen, but I think luck tends to kind of equalize, and I don't think it's sustainable. And what I'm trying to teach you guys is at least what I think are things that become more sustainable are the math of high probabilities.
No, that analyze tool was great. I mean, I think it's a great thing in TOS.
Yeah.
It's amazing, actually.
So Dale, I switched to Apple and was just looking at its expected move in November, and that's 12.59 points. You're saying in price.
Dollars, yeah.
Dollars, yeah. Could go up or down.
Right.
And that's all? Wow. How about that?
And the thing is, if I look at VIX, VIX is the fear index for the overall market, is at 28.11. Last year, most of last year, it was at 13. So, if I look at this over a 1-year chart and I'll look at, last year it was 13.5. Here we're coming up on February. Nobody had heard, of COVID, except if you're in China somewhere. And then all of a sudden, boom, you see it shoot up to 25, 26. It shot up to 84. That's kind of what I mean is Warren Buffett says when there's blood in the streets, and you hope it's not your blood, but it's just, those are the times where the Chinese word for crisis is danger and opportunity. And, both of those are going on simultaneously. You can get real hurt by it, or you can also find the opportunity. And I'm convinced that the leaders will find the opportunity that the victims will swear never existed. So that's kind of part of what you want to keep some dry powder. And the danger is, you're not expecting something like that to happen. And so sometimes all your capital's tied up and you don't have the capital to take advantage of it. Or you thought that, oh man, this is high. 40, that's high. And by that time, you've used all your dry powder. So that's kind of the advantage of maybe trading a fraction of your, so that you can have some dry powder for these kind of black swan events. But it's trading at 28.11. And usually when volatility is high, you can see it start to come down. When people realize, oh my God, the world didn't end, you'll see it start to trickle in, and that's where you make money from all this premium that you've sold. So that's one thing that I wanted to talk about. The other thing is I know there's not a lot of time left, but in case you haven't found this, you can click on this on-demand tool, and you can set any date in the past. And you can try and trade it. You can even play around with paper trading or something if you think you've got some signals that work. I could set this and say, all right, I want to go back to that time here when the VIX was at 83, right? What was the date? March 18th. So let me see. Okay, if I can go down here to March 18th, and I want to see kind of what it was, at 1:06 in the afternoon on March 18th. So I can click on go. And, you can go back and it'll update here. It's buffering now, but eventually, boom, you're back to the future. You're March 18th. And you can say, okay, I'm going to see what it would, what kind of premium and what things are selling for right now if I'm selling premium, at this peak. And you can play around with it. In different time frames. So it's pre-buffering, but I've been back testing a specific strategy, selling iron flies when the guys in Wall Street are taking lunch, as an idea of kind of see what the probabilities. And right now it looks like this trade I'm trying out, it's got, close to a 75 to 80% probability of success. And so, if you find something that works like that, then you're like, okay, well, I want to try and trade it for real. It's best to start out small, trade the micro futures maybe, which is 1/50th the size of ES. And then, if it works, then you can scale it up, start off at the 1-2 tables, till you get your game right, or 4-8 limit. If you're Quan, you invest $11,000 playing online. So you learn how to play. If you're watching this, Quan, sorry, it was just a joke, okay? All right, there you go. That's my disclaimer. All right, Quan won't watch it. He doesn't even want to do his homework. He won't watch this. So anyway, there's something I can show you there. And I showed this the other day to Greg on some stuff I'm back testing. So that's kind of cool on demand. So you got the capabilities of back testing some strategies and trying some stuff out if you want. So I'm looking at kind of at 456. Any questions, comments, thoughts, debates, anything?
No, I think got a lot to learn.
All right.
Amen. You can bet I'll be rewatching this one.
All right.
For sure.
All right, guys. Well, enjoy. I panicked there for a second. I was like, did I start the video? Oh, yeah. That's always a bad thing when you get at the end and you realize you haven't even started it. We had one that happened the other day, but enjoyed it, guys. Keep up the good work. And we'll chat in Slack and any questions that come to your mind. But we've kept this to the hour. That's always my goal, so that we know nothing like these marathon meetings, right, Johnny Juice Ball?
No doubt.
You resemble that remark?
Yeah, no doubt. I hate I like 10-minute meetings. So
Yeah. All right, guys. We'll see you on Slack, and we'll see you next week.
Thanks a million, Dale.
Yeah.
Thanks, guys.
Good evening, guys.
All right.
Bye-bye.
Bye.